Hey Econ students, Mr. Castro here with a video to review a little bit about monetary policy. I think I'm probably going to do this here, at least a couple of these a week because we're going pretty quickly through material that's kind of complicated. So we wanted to review what we did in class this week on monetary policy. So a couple things to remind you. What we're looking at here is macroeconomics, so two basic things, right? First part of macroeconomics is how do we measure the economy? We measure either growth through GDP, we grow unemployment through the unemployment rate, or we measure inflation through CPI. And then the next question is, what can the government do to influence the economy, especially when things are going wrong? And on that side of macroeconomics, we're really looking at two things. Monetary policy, which is putting money into the economy or taking money out of the economy, or we're looking at fiscal policy, which is taxing and spending. So what we started off this week with was monetary policy, which is putting money into the economy or taking it out. And the monetary policy is controlled by the Fed, the Federal Reserve. And the Federal Reserve will either do an easy money policy, where they'll pump money into the economy, or they'll do a tight policy, where they'll take money out of the economy. And they have three tools to do this. The tools they have are the discount rate, the reserve requirement, and the open market operations. So discount rate is the rate that the Federal Reserve charges to all other banks and then affects all other interest rates. So if they raise that rate, all other interest rates go up, which make it more expensive to get loans for cars and homes and credit cards and all those other things. And so if it's more expensive to do that, less people will get loans, less people will then purchase those items, which will then bring down GDP. Reserve requirement, that is the amount of money a bank must hold on to and not loan out. The higher that reserve requirement, the less the bank can loan out. The lower the requirement, the more the bank can loan out. And the open market operations, all that means is the buying and selling of bonds. And so if the Federal Reserve buys bonds, that means they take bonds out of individuals' hands and put money in their hands, so they have more money. If they sell bonds, that means they take a bond and they sell it to individuals, and then the individuals then hand over their money. And you have a bond instead, so they're taking money out of the economy. So these are the three tools. So remember, this is a simplified look at the economy, right? So this is GDP graphed over time, which creates the business cycle. So when GDP is increasing, we have an expansion. That means the economy is doing well, right? Unemployment is going down. But we can get to a point where the economy might be going a little bit too hot. And if it's going too hot, then we have inflation. And inflation numbers are measured by CPI. And if that comes out and it shows inflation over 3%, the Fed starts getting reserved and wants to take money out of the economy. And then if we're down here on this side, we're in a contraction, and that means GDP is going down. If GDP decreases 2 quarters or more, that's called a recession, right? But GDP is going down. What does that mean? That more people are losing their jobs, unemployment is going up. And so if we're in a contraction recession, the Fed will probably want to put money into the economy. So what you need to know is basically, if I give you a situation, you need to tell me, what would the Fed do? What would their policy be? And so if I give you a situation here, and I told you that GDP has gone down for 2 quarters and that unemployment is increasing, what would you expect the Fed to do? They would want to put money into the economy. And so what would they do? They would do an easy monetary policy or easy money policy. And this would all be about taking money and putting it into the economy. To do what? To try to get that GDP number to increase and go up. So what would they do? In this situation, they would lower the discount rate. They would lower the reserve requirement. And they would end up buying bonds. Right? Because with this, they would end up taking bonds out of people's hands and put money in people's hands. And all these things would put money into the economy. Lower discount rates, that means more people would borrow money to buy homes and cars and other big ticket items. More with lower reserve requirement, banks would be able to loan out more money, and individuals would then purchase things with that money. And then with buying bonds, then more people would have money in their hands, and they would probably buy stuff with it. And all of that would help to get GDP going and to get us into an expansion. All right, and the other way around, if the economy was increasing, at an unsustainable rate. And by that, I mean it's increasing to a point where demand has increased so much, supply is not keeping up with it, and inflation is getting out of control. And so really the concern for Fed more than anything is not necessarily an expansion, but when the economy gets too hot and CPI numbers show inflation rates above like 3% or so. And so if that happens, what does the Fed do? They want to take money out of the economy. So instead of taking money and put it in, which they want to do here, right, they want to take money out, right? So they take money and get it out of the economy. They want to slow it down. And so in that situation, we would call that a tight money policy. All right, and so what would they do in a tight money policy, right? So the discount rate, they would increase it. It'd go up. Reserve requirement would go up. All right, and then what would they do is they would sell bonds, right? So they take money out of people's hands and put a bond in their hands, right? Get money out of the economy, right? So all of these things would have the effect of doing what? Of slowing down the economy. If interest rates are going up across the board, less people are going to get homes, less people are going to buy cars, less people are going to use their credit cards. It's more expensive to borrow, so less people will be doing that, which means less purchase is going to happen. Raise the reserve requirement, banks have less money they're able to loan. And then selling bonds, right, less people have money in their hands instead they have these bonds. And so all of that will have the effect of slowing down the economy. Now the trick is to slow it down just a little bit, because if they overreact, then what happens? We go into a recession. So there's a fine line of what the Federal Reserve is doing on a consistent basis to try to manage our business cycle. So that's the first thing that you need to know. The second thing you need to know is the graph that's related to it. And the graph's relatively easy, but let me show you an example of that. All right, so let's take a look at the graph for monetary policy. And this is a supply and demand graph for money in the entire economy. And so just like a supply and demand graph we've done before, in our y-axis we have our price, and then our x-axis is quantity. So with money, what is price? That is your interest rate. Interest rate is the cost of borrowing money. So interest rate is the same thing as price. If we're saying price for hamburgers, interest rate is the cost of borrowing money. All right, so interest rate on the y-axis, and then we have our quantity of money here. And then so you'd have a demand curve for money, right? Money demand, right? So this, just like any other demand curve, slopes downwards, right? And the law of demand is true here, right? So the higher the interest rate, so let's say this is like a 10% interest rate right here, right? This is where the demand for money would be. Not a whole lot of people. If this is like 20% interest rate, you're probably not going to borrow money to get a car, right? Or borrow money for a home at that time, right? It's just too expensive to borrow money. And you go down here, if interest rate's like 1%, demand increases dramatically because it's a lot more cheaper to borrow money, right? So law of demand still stays intact here for money. The supply curve looks differently because it really isn't a curve, right? Basically what it is, it's a straight line, right? Straight vertical line, right? That's money supply. Why? Because it's about the amount of money, right? It's all about just there's a certain amount of money that's there. And so let's say right here, let's say this is $1 trillion, right? So let's say there's $1 trillion that's flowing in the economy right here, right? And this is where it is. And the point at where the supply and demand intersect is our equilibrium price for interest, right? Or equilibrium interest for money. And so let's say right now that's like 5% or something like that. Okay. So what does the Federal Reserve do? The Federal Reserve influences the shifting of the money supply, right? They either increase it or they decrease it. And they do that depending on where we are in the business cycle and what they want to do. All right, so let's look at an example. So as a possible test example I could give you, if I gave you the numbers that said that GDP has decreased by 6% and unemployment has increased to 7%, right? That would let you know that we are in a contraction. We're not in a good situation in the economy, right? GDP is going down and people are losing their jobs. So what would the Fed would do with this policy is they want to put money into the economy, right? So what policy would they use? They would use an easy policy, right? Easy money policy. They want to put money into the economy to get us going, right? So once again, what are the tools? What would they do with that policy? Is they would decrease the discount rate. They would decrease the reserve requirement. all right, and then they would buy bonds, right? So they would end up taking a bond out of someone's hand and putting money in their hands, right? What would this do? This would all have the effect of shifting the money supply curve to the right, right? This is what an easy policy does, right? Shifts money supply to the right. And then what happens to the equilibrium interest rate? It decreases, right? So this is our new equilibrium. So let's say we have a decrease here. Let's say that's like 2%, right? And then what's happened to the money supply, right? That is increased. Let's say now it's like 1.3 trillion. Right? And what does this have the effect of? More people are now borrowing money, but what are they doing with that money? They're going to take that money and they're going to purchase stuff. They're going to purchase big ticket items. Businesses small business owners might take out a small business loan to expand. More people will buy cars. More people buy homes, right? All of these things will have the effect of increasing GDP, increases GDP, and then those businesses will have more profits, they'll hire more people, and hopefully unemployment will go down, and they'll take us out of a contraction. All right, and then the other way around, if I gave you numbers that showed that the economy was expanding, GDP has increased by 5%, unemployment is staying stable at like 4%, but this is the key number. If I give you something saying CPI numbers show CPI increase of 10%, that shows you that inflation is a major issue, right? All of a sudden, the purchasing power of the dollar is going way down, right? And that's going to cause a lot of disruption to the economy, right? So CPI is kind of the big number for the other side of this. And if CPI shows that inflation is a concern, then what is the Federal Reserve going to do? They're going to take money out of the economy, right? They want to take money out to slow it down, to cool it off. It's getting too hot, right? So with that, they would use a tight policy. Right? And so with that, they would increase the discount rate, increase the reserve requirement, and they would sell bonds. They'd take money out of people's hands and put bonds. And what would this do? This would now have the effect of shifting the money supply curve to the left, right? So it'd shift to the left. As it shifts to the left, what happens? Interest rates go up across the board. So let's say maybe this is like 8% now instead of 5%, right? And then now let's say this is like 800 billion in supply of money, right? Versus a trillion, right? And now this is our new equilibrium price, right? Interest rates went up, but the quantity, where the supply of money went down. Now, less people are getting loans. If less people are getting loans, less people are purchasing cars, purchasing homes. Businesses might not be getting out loans to expand their business as much. This will all have the effect of cooling down the economy. All right, so that's how this works. This is how it all comes together. So if you need to watch this video a couple of times, let me know if you have any questions about any of this.